Good afternoon. Welcome to our webinar on what tax reform means for chiropractors. My name is Jeff Boudier, CPA. I'm the Managing Director of Chiro CPA, aligning chiropractic finances for success. This is a webinar we created to answer common questions we're receiving about what the tax reform bill that passed a few weeks ago is going to mean for chiropractors and chiropractic offices. So let's get right into it. Before we begin, our attorneys want me to read you this disclaimer. This is based on our interpretation of the law, this being this presentation, which can change at any time, is not intended to be a substitute for professional advice. The tax changes mentioned do not take place until 2018, that's this year, or later, and many changes will sunset in 2025. Any changes to your practice or personal finances should only occur after you consult with advisors who have knowledge of your facts and circumstances. So this is a fairly basic boilerplate that our attorneys require us to include. So today we're going to talk about tax reform primarily as it impacts two areas, the first being your patients and the second being your practice. The bill itself was about 1,000 pages, or the conference report on the bill was about 1,000 pages. We've gone through most of the areas that are applicable to U.S. businesses. There's a lot of changes related to international businesses, but most of you probably won't have an interest in that area. So we've gone ahead and we've distilled that down to the 4 things we think are the most important in each of these areas. So 8 things in total, fairly manageable. We should be able to get through these briskly. So the first step here, we're going to talk about your patients. The 4 things you need to know are, 1, the individual mandate is gone. 2, the medical expense threshold is slightly lowered. 3, there have been no changes to HSAs or MSAs. And 4, the definition of non-deductible penalties has been expanded. I'll cover more on that in a few minutes here. We're going to cover each in turn, starting with the individual mandate. So the individual mandate is no more. This has been a target of both House and Senate Republicans for quite some time now. The individual mandate was a requirement that individuals have health insurance, or if an exception didn't apply, they pay a penalty. Well, what's happened now is the penalty has been set to 0, so there is in effect no individual mandate. However, the business mandate remains. So business owners are not exempt from the requirement to purchase health insurance for employees if they meet the limits. So what this means for you as a chiropractor is you're probably going to see patients not renewing insurance due to the high cost. So if you had some patients who it seems like every year they have a new insurance plan or something like that due to cover California, if you're in California or one of the other remaining exchanges, you may see those patients switching to a cash pay model, and you may want to make changes now to accommodate that. So if you have a practice that's really heavily dependent on private insurance, you're going to want to evaluate how many of your patients have their own insurance versus employer-provided insurance to measure your exposure here. You may already be seeing this and having patients that are calling and canceling appointments because they don't have insurance anymore. But it's a really good thing to understand your practice mix in terms of how many patients, what percentage of your practice is made up of private pay patients who are on insurance, what percentage is made up of cash pay patients, what percentage is work comp, personal injury, et cetera, et cetera. So you're going to want to do that. That's something to keep in mind here. At the same time, medical expenses used to be limited to an amount exceeding 10% of adjusted gross income for those who are below 65. This is a temporary, so most people did not get to take advantage of this. The threshold is now 7.5% of AGI, which is slightly lower, so more people will be able to take advantage of medical expenses, but a lot of people won't. So, for example, if you have $100,000 in adjusted gross income, you're going to need to have at least $7,501 in medical expenses in order to take $1 of medical expenses. This sunsets in 2019, so it's really only a 1-year provision, but you may see more patients willing to spend out of pocket on medical expenses, which is good because it'll boost your cash pay. HSAs and MSAs. So the original plan under the tax reform was to eliminate both of these I'm happy to say there have been no changes under the final tax plan. So if you have patients who need to pay out of pocket, they may be able to use their HSA or MSA funds to pay you. You may already see this where you get checks coming in that have HSA or MSA account on them. But this is something to keep in mind is that, so we lose the individual mandate, which means you may have more people transitioning to cash pay. But medical expenses are now a bit more deductible and you still have HSAs and MSAs, so it should be so cash pay should become a bit more advantageous for you. The fourth thing I want to cover is non-deductible penalties. The tax bill is going to expand to the definition of what a non-deductible penalty is. My colleagues and I have a disagreement in that my colleagues primarily believe this is targeting SEC companies that are being targeted by the Securities and Exchange Commission. However, it's a fairly broad definition, and it's possible but not likely that this could encompass RIC repayments. That's the Recovery Audit Contractors for Medicare. So I think it's going to be especially important now to make sure you're compliant with Medicare procedures. Remember, there is no such thing as an opt-out from Medicare for chiropractors. Anyone who tells you otherwise is either wrong or lying. So you're really going to want to make sure that for your Medicare segment of your practice, you're compliant with Medicare procedures. Because there's the chance that if an RIC happens and you are required to pay back money to Medicare, it may not be considered, may not be able to write it off on your taxes. So now let's talk about your practice. The four things to know here are, 1, corporate tax rates have been simplified. A lot of people are saying they've been reduced. That's not necessarily the case. There's now a deduction for qualified business income. We'll talk about that a bit more. Section 197, Section 179 expensing has been expanded. We'll talk about that, as well as the net operating loss carryback is gone. Let's start with corporate tax rates. So these have been, many is saying they've been reduced, and in reality they've been simplified to one single rate of 21%. Previously there was a range between 15 and 39%. So if you had $50,000 or less in net business income, this is a tax hike, unless you were a personal service corporation. I'll get into that in a minute. But otherwise, it's a tax break. The nice thing is that personal service corporations, which many chiropractic offices would qualify as, are essentially it's a type of corporation that's primarily professional services. These were taxed at a flat rate of 35%. That rate is now gone. It's possible the IRS could try to resurrect it by regulation, but it doesn't exist anymore. So now C Corps may be slightly more attractive for chiropractors from a tax standpoint. Moving on to the deduction for qualified business income. There's now a 20% deduction from taxable income for qualified business income only on individual tax returns. This avoids an issue for S corporations, LLCs, and partnerships with a decrease in corporate tax rates. The problem with reducing the corporate tax rate so low is that it then becomes a disadvantages people who are operating under LLCs or S corporations or partnerships, and that they're being taxed more. So this was a way of offsetting it. There's some caveats here. The big one is there's an income restriction. So if you make over $157,500 in taxable income if you're single, or $315,000 in taxable income if you're married and you're filing a joint return, you're not going to get this deduction as a service business. Chiropractic is a health business, so it would be a service business. However, if you have a side business and exceed the amount, the deduction is going to be limited based on W-2 wages paid. So, for example, if you have a nutrition side business where you're selling supplements or something like that, there may be an argument to be made that that's where you can spin that off as its own business, take the deduction, and then it would just be limited based on the wages paid. So Section 179 expensing. Section 179 allows immediate expensing of qualified equipment and now improvements. Previously, it was primarily just equipment. So it's been increased to $1 million for $500,000, and that you can outright off up to $1 million a year and equipment. The limits also increased to the limit in total equipment purchases is also increased to 2.5 million. Most of you probably will never get anywhere near this, but if you're thinking of buying a new adjusting table or new office equipment, this may be a valuable thing to keep in mind. The big win here is that some improvements are now going to be capable of being expensed rather than depreciated over 15 years or whatever the period is. 15 years is the period for tenant improvements. So, for example, you have to build out your office, you have to repair something in your office, that could have to be capitalized, which is a real pain. Now it's possible you may be able to write it off instead. The last major change is that the net operating loss carryback is gone. So you used to have to carry losses back 2 years and then forward. So, for example, let's say you had a fire that destroyed your business or destroyed your office, and you lost a significant deal of revenue, and ultimately you had, say, a $20,000 business loss for the year. You used to have to take that back 2 years. So in this case, a loss at 17 would go back to 15, and then 16, and then 18, 19, so on. So you can't do that anymore, and now you can only carry losses forward. So the key thing here is that you can't count on future losses to offset income now. It can only offset income going forward. So if you're having a really good year now, but you're expecting a bad year next year, you won't be able to use that to offset this year. So that pretty much sums up today's presentation. I know we went through everything a bit quickly. We did want to be respectful of your time, and many of you are probably watching this even between patients or on lunch. So if you have any questions, feel free to send them to my name, Jeff, at thechiropcpa.com. If you'd like to chat more in depth about what we can do for your practice, go to this link, and that link should be live and should work to schedule some time on my calendar for us to chat. Thank you for watching, and have a great day.